Hello there, welcome back to our channel. Still on preparing for the SIPSEC final exams. This is a question paper from a mock exam. We want to look at question 2. Uh, we are here on question 2. So that's where we are starting. We can know what is on top of that. Right. The question reads: the general ledger of Kwanda Limited indicated the following balances on 1 January 2022. Then we put balance of equipment and then opening balance again for provision for depreciation on 1 January 2022. So this question is on double entry on disposal of fixed assets. So we are going to go through that. So we are given balance at the beginning year and year. So we want to include those balances in the accounts there, because the question requires us to prepare on the required part. We have got office equipment account, and then provision for depreciation account, and then office equipment disposal account. That's all we are interested in this question, right? So let's go to the office equipment account and see. I've already put the year in terms of the balances at the beginning, because we are already given those balances. Balance BD 150. This is our balance BD in this case of office equipment. We have got 150. Then for provision for depreciation, it's 40,000. So all those balances are already entered there. So we now want to look at the double entry. Now let's go statement by statement and try to see how can we employ our double entry. Right, if you go to item 1, there, we are now here. During the year, the following transactions took place. Then 1, the company purchased office equipment worth 50,000. So whenever we purchase equipment, we are purchasing, so the double entry on purchasing, we are debiting the equipment that we have purchased. We debit the equipment, and then we credit. If you are using check, you credit bank. If it's cash, credit the cash. And then in this case, we are told that it's Wallet PLC Limited, so we are going to credit Wallet, because it's what credit. So, but we are only interested on this part of debit, of course. The equipment is the one that is being asked there. So we are going to go to the debit side of the equipment account and input that one. We have got this is on credit, so we are going to write Wale PLC Limited. Wale PLC Limited, and it's an amount of 50,000. Then we go to the next item. Let's try to see what the next item is reading us for us. The next item is number 2. On 10th September 2022, the business further purchased the new equipment at a purchase price of $75,000. And then next sentence, custom duty, carriage costs, and installation costs were charged at 25,000. So here we've got a scenario that we've got extra costs that you are being given there in terms of customs duty, carriage costs, and installation costs of 25,000. But basically, there's an asset that has been bought there, a fixed asset. So these costs that have been are being included here, they are capital costs, installation costs, etc. They are capital costs, so they increase the value of this non-current asset. So we are going to add 75 plus 25, then we get 100,000. So when you get 100,000, that is going to be our cost for that asset. So we are being told that it was bought by, I think the question is silent there. Let's try to see. The business that purchased new equipment at a purchase price of 7,000 silent. So the assumption is that it was through bank. So we are going there on the debit side on equipment accountant. Either that amount and say bank 100,000. So that is what we have there. Then we go on to the next item. Then now on number 3, the company sold office equipment for $36,000 cash. So the first one of selling on $36,000 cash, this is the one that we want to see in terms of this. Let's just put the double entry there on what happens there when a non-current asset is sold on cash. So disposal on cash. This is disposal on cash basis. So when we have such a scenario, we debit the we debit cash because we are receiving cash. So this one has been sold for cash. So we are going to debit cash account, and then we are going to credit, credit disposal. So we are going to debit the cash and then we credit disposal. But according to our question, the disposal is the one that is there in the question. So it's the one that we are going to credit with the amount of cash that was received, which is 36,000. So we go to the question and enter that 36,000 on the debit of the disposal account. We debit it on the debit of the disposal account. Sorry, we are crediting cash. We are debiting cash and crediting disposal. So we go to the credit of the disposal and put cash, and we are told that is 36,000. So we are going to put 36,000 this side. Right. So we go again and check what we have on the same statement. We have got still on the same statement there. Still on the same statement. It was sold for 30,000 cash, and then next sentence saying the equipment was bought on 1 April 2020. The equipment was bought on 1 April 2020 at an original cost of 245,000. So this cost price is still there in the books in the equipment account. So since this non-current asset is moving outside the business, we need to remove it in the books, in our books. So double entry on removal of non-current asset. Removal of non-current assets. Removal of non-current assets. We are going to debit. We debit disposal. It will be on the debit side of non-current assets. Then we credit now the equipment account to remove it. But as we are only listed on the equipment account, because that's the one that is being asked in question. So we go to the equipment account and credit the cost price. That is 45,000. So when you go to the credit of the equipment account, there we are going to write disposal on the details part. Here is a disposal. What 5,000. Right. Then there we try to see again what's next to here, which needs to be entered there. Right. So I think we finished there. So what is left now is now the issue of depreciation. The issue of depreciation, because this non-current asset that has been sold is what accumulated depreciation that has to be removed from the books. Remember, it's being sold on 1 April 2020, and we are being told that it was bought on 1 October 2022. It was bought on 1 October 2022. Here, there it's specifically 1 October 2022. That's when it was that's when it was sold, and then we are told it was bought now on 1 April 2020. So we need to calculate the accumulated depreciation from when it was bought up to date when it's going to be sold. And then we remove that accumulated depreciation in the books. Remember, also we are going to calculate depreciation for that non-current asset that has been sold as it go out of the business for the period that it has stayed for 2020. But if you look in our question, let's look at the periods or financial periods. That's important. Also, we are told that what is also key there is that the financial year is following balance on 1 January 2020. So it's starting on 1 January. That's the most basic thing. It's starting from 1 January, January to 31 December. That's our financial year. So it's going to help us in terms of allocating, in terms of the depreciation according to how long is that current asset stayed in the business, you see. So we now go to the explanation that we have there. So it was bought 2020, so it means it stayed in 2020. Then 2020 was the first year, then 2021 second year, then 2023 was the third year. So what it means is that it was now sold in what? It was now sold in 2022 when it was bought in 2020. So 2020 for the first one, 2021 second one, 2022 third one. But in the first year, and third year, it didn't stay the whole year. So we need to allocate in terms of demand that it really stayed in the business. But it only stayed the whole year for the second year. So let's try to calculate the depreciation there. Let's see there so that we quickly calculate the depreciation that is needed. That's we need to calculate the depreciation for first year, second year, and third year so that we come up with the total depreciation that needs to be removed. Right, I think we can now calculate that one. Right, we go now to the first year. We say first year, during the first year. What happened during the first year is that it's depreciation again, it's 20% per annum using the straight line method, which means the formula is that we're just going to say percentage times cost. So our cost is 45,000 for that non-current asset. So for the first year, let's look. It was there. It was bought on what, April 2020. So it was there in April, February, March. Sorry, it was there April, May, June, July, August, September, October, November, December. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9. So it stayed 9 months. So for the first year, we are going to say it's 9 months. So it's 9 over 12. Then we multiply by 0.2. The percentage, then the cost is 45,000. Then when you do that, let's try to calculate that one. 9 over 12 times 0.2 times 45,000. What do we get there? We are supposed to get 6,750. So that's for the first year. Then we move on to the second day. Second day now it was for the whole year. So you're not allocating in terms of the months that that non-current asset stayed. Right. So we go to the second year. Go to the second year. But for the second year now, it stayed the whole year. So you're just going to say 0.2 times 45,000. Then when we do that, we are supposed to get 9,000. So it was 9,000 for the second year. Then we go to third year. Third year, we are told that it was then sold on 1 October. So it means it stayed October, November, December. So it stayed 3 months. So what we are going to do, we are going to say 3 over 12 times 0.2. Then we multiply by 45,000. So when you do that, you are supposed to get. Let's try to see there. It stayed 3 months, so we are saying 3 over 12. Then we multiply by 0.2, and then we multiply again by 45,000. Then you get 2,250. For this is for the third year. So you would see now for the whole year now, I mean for the whole period that it stayed, we are going to add those figures and see the total. So we are now going to say for the whole year, we now say 6,750 plus 9,000 plus 2,250. Then what you get there, let's try to calculate here, is 6,750. Then we add 9,000. Then we add 2,250. Then we get 18,000. Gets 18,000. So here it's 18,000. So this comes to be the depreciation, accumulated depreciation for this non-current asset for the whole period up to the date when it was sold. So we go to the non-current assets, to the provision for depreciation account, and enter that amount, 18,000. So as we see for our provision for depreciation account, the balance is on the credit side. So what it means now is that 18,000 is on the credit side. So we are going to say here disposal. So double entry for when you are removing depreciation, we debit the provision for depreciation, then we credit disposal account. So here we say 18,000. Right. So when you say 18,000, this one is also affects disposal. So we are going to end again that 18,000 into the disposal account. So this one is coming from provision for depreciation. So we can just say depreciation. Depreciation, which is 18,000. So when you do that now, we now need to calculate the depreciation for the year that we are supposed to end on the credit side now with the provision for depreciation account. That's the one that we are left with. So we go there and try to see. Already we know that the figure for depreciation for the asset that was sold during the year that it was sold. We now have the figure. Right. Right. Let's try to see there so that we do it just near where we have the information there. Right. So right. So we go here and say depreciation for asset sold. Let's start by asset sold. The asset that was sold. Asset that was sold. The depreciation, we calculated it there, and we got. Let's try to see there the bottom there. Calculated it, and we got 2,250 in the third year. So that's depreciation for the asset sold for that year. For 2,250. Right, 2,250 for asset sold. Then the remaining vehicles, the remaining equipment, the remaining ones. Now we are now saying we had 150 at the beginning. So for the remaining, we had 150 at the beginning. Then we subtract the one that was sold with the 45,000 cost price of 45,000. Then under that you get to multiply by 0.2 to get for the remaining ones. So if you do that, calculation, we say 150 minus 45, get 105. Then we say 105 times 0.2. What do you get there? Let's try to see 150,000 minus 45,000, get 105, then you multiply by 0.2. You're supposed to get 21,000. So this one will give us an answer of 21,000. The remaining ones. Then there were those that were bought during the year. The first one here was bought on what? On the first one was bought on 31 March, and we said it stayed 9 months, isn't it? So we are going to say 9 over 12. We multiply by 0.2. Then we multiply by the cost of that equipment, which is 50,000. Right. So when we do that, 9 over 12 times 0.2 times 50,000, we get 7,500. So here we are going to get 7,500. And then for the third one, which was on 3rd September, the business further purchased the new equipment at a purchase price of 75,000. And then we said it would just 25,000 on top to make it 100,000, and it said only 3 months because it was on 30 September, so it said October, November, December. So it's 3 over 12 times 0.2 times the cost that we have there, which is 100,000. Then you get, if you do that, let's try to see 3 over 12. Then we multiply by 0.2. Then we multiply again by 100,000. We're going to get 5,000. So here we put 5,000. Right. So we now add this one to get the depreciation for the year. This one plus this one plus this one, then we plus this one, then we get total. So let's try to add that one. We have 2,250, and then we add 21,000. Then we add 7,500. Then we add 5,000. Then we get 35,000. Get 35,500. 35,500. Let's add again to get the correct figure there, which is 2,250 plus 21,000 plus 7,500. Then we add again 5,000. Then we get 35,750. So our answer is 35,750. So this is the total depreciation for this. So for this depreciation, the double entry is that we created the provision for depreciation account, then we created the profit and loss account. So we go to our accounts, and we are going to do that on the provision for depreciation account now. We just say here this amount is supposed to go to profit and loss. It's supposed to go to profit and loss. It's 35,750. 35,750. So having done this now, you now balance your accounts. We start with the office equipment there. We know how to balance. We add the debits, we add the credits, we compare the totals, we put a figure, we put it in between the lines. Then we look for the difference between the two. The difference between two becomes the balance sheet on the side where we have a smaller figure. So basically, that's what we want to do here. So yeah, for office equipment account, we put 45,000 on the credit. We have only 45,000 on the credit. Then on the debit, we have 150. 150,000 plus 50,000 plus 100,000. So we have 300 on the credit side. So it automatically 300 will come in between the double lines here. So we have 300,000 here. Then we come here again. We also have 300,000. Then we subtract the 45,000 on the credit side to get the balance, which is 255. So here we've got 255. And this becomes our balance sheet. Right. So that's what we have there. And then we go to provision for depreciation. We are going to do the same thing. So if we add the credit side, we've got 40,000. 40,000, then we add 35,750. Those are the two that we have. Then we get 75,750. Get 75,750. 75,750. That's on the credit. On the debit, we've got 18,000. So 75 is the greater one. So we make our double lines here. Right. So 75,750 in between the double lines. 75,750. 75,750. Right. Then after having done this, now we make a subtraction. 75,750. Then we make a subtraction of 75,750 minus 18,000. Minus 18,000. Then we subtract 18,000 from there, you get 57,000. That's our balance CD now. 57,750. So this is our balance CD. Then obviously our balance BT will be carried for the next year. So starting with office equipment, our balance BT will be on the debit side below the lines. And then for proceeding with depreciation, our balance BT will be on the credit side below the double lines. Then on disposal, we don't have, for disposal account, let's take note that we don't have a balance CT or BT. Whatever difference we have there is supposed to be transferred to the profit and loss account. So it's either we got a profit on disposal or we got a loss on disposal. So let's check out on disposal. So on disposal, we have got cash 36 on the credit and depreciation, 18 on the credit, and also we are supposed to put on the debit the cost price of the non-current asset that was sold. And we know that the non-current asset that was sold, let's recheck the amount of that non-current asset that was sold. It had a cost price of 45,000. So we are going to have 45,000 there, and the figures coming from the equipment. We credit the equipment account, and then we debit the disposal. So here we're just going to say equipment and 45,000. So for us now to see whether we've got the profit or loss on disposal, we add the total there on the credit to see how much do we have there on the credit as a total. So if we add, we've got 18,000 there. 18,000 plus 36,000, then we get 54,000. We see now the credit side is bigger, so it's going to come in between the lines. Here, 4,000. So it's also going to come here in between the lines is 54. Now the difference now is 45, 54 minus 45. Then we get 9,000. So here we've got 9,000. So this one goes to the we just say profit or loss, goes to the profit or loss account. But we need to determine whether it's a profit or loss on disposal. So when the balance is on the smaller figure is on the debit side, like this scenario, it means it's going to credit in the profit and loss. We debit the disposal here, and we are going to credit the profit and loss. And whenever we credit the profit and loss, it's a profit. So here we are having a profit on disposal. Profit on disposal of 9,000. So but when the credit side is a smaller figure, it means we're going to input our profit and loss on the credit side and debit the profit and loss account. So when debit the profit and loss account, it's now a loss on disposal. So we have to take note that in the profit and loss account, we have income. All incomes are on the credit, and all expenses are on the debit. So whenever we credit it, it means it's income. So in this scenario, we are going to credit it, it's income, it's profit on disposal. So that's what we have in our question, guys. Keep tuned. We are moving forward as we prepare for our ZIMSEC exams. Subscribe so that you get hold of new notifications of new videos. Thank you for listening. We meet next time.